$500, 000 in utilities and staples felt safe, until the correlation data shows it isn't. You're 3 years from retirement, your portfolio is weighted 70% defensive, and you sleep well knowing dividend stocks protect you when volatility spikes. But Federal Reserve data from 2024 reveals a shock. Defensive sector correlations with equities jumped from 0.65 to 0.85 plus during the last 2 corrections, exactly the opposite of what you expected. That gap between safety and reality could force you to claim Social Security 3 years early, cutting lifetime benefits by $80, 000 to $150, 000. Stay with me for the next 4 minutes. I'll show you the exact correlation threshold where your defensive holdings stop working, and the one portfolio tweak that historically reduced that blow by 35 to 45%. Here's the wrong belief most pre-retirees hold. Defensive stocks move independently of the broad market. Utilities, consumer staples, and rate are supposed to zig while equities zag. That's the entire premise of loading up on XLU, XLP, and dividend ETFs before retirement. The comfort comes from the assumption that when the S&P 500 drops 20%, your defensive holdings drop maybe 8 to 10%. The diversification is real, right? Wrong. The data tells a different story. During the 2020 COVID correction, utilities correlation jumped from 0.62 to 0.81 within 3 weeks. In 2022, during the Fed rate hike cycle, staples correlation climbed from 0.68 to 0.87. The research is clear. During stress periods, everything correlates upward. That's when the diversification you relied on evaporates. So what's the real cost? A retiree expecting 8 to 10% annual volatility in a 70% defensive portfolio may actually experience 15 to 18% volatility during corrections. On a $500, 000 portfolio, that's $1.75, 000 to $1.90, 000 swing when you're supposed to be taking withdrawals. Most people panic and sell at the bottom. Others don't. They just can't wait out the recovery because they need income now. So they claim Social Security early to cover the gap. That decision locks in $2, $400 to $2, $700 less per month for the rest of their life. Over 30 years of retirement, that's $864, 000 to $972, 000 in foregone benefits. Here's where it gets worse. The correlation trap is hiding in plain sight in your ETF prospectus. XLU, the utilities ETF most pre-retirees own, holds 28 of the same large-cap stocks that appear in the S&P 500. When market sentiment shifts to risk-off, the biggest utilities get hit hard because institutional money that owns utilities also owns the broad market. They're not independent positions, they're crowded trades. The proof is in the rolling 12-month correlation tables. From January 2020 through October 2024, utilities correlation to equities averaged 0.71. During correction windows, defined as 10% market drawdowns, that average jumped to 0.83. That 12-point spread eliminates 40 to 50% of the diversification benefit you thought you had. Federal Reserve data on sector rotation also shows this pattern repeating. In past 3 recessions, utilities outperformed equities by 300 to 500 basis points, but only asterisk after asterisk the correction, not during it. The actual drawdown period is when correlation spikes highest. By the time utilities stabilize and outperform, the damage is done. So what's the tweak? The research suggests a 15 to 20% allocation to true non-correlated assets, not more dividend stocks, but bond ladders, treasury inflation-protected securities, and a small allocation to commodities or gold. These holdings historically maintain 0.3 to 0.4 correlation to equities even during corrections. That small shift reduces portfolio volatility from 15 to 18% to 10 to 12% during stress, enough to let you stay invested and avoid the Social Security claiming trap. The uncomfortable truth: the safety trade in summer 2024 is crowded with pre-retirees making the exact same bet. When correlation assumptions break, and historically they do every 3 to 5 years, the positioning reverses fast. The investors who move first aren't the ones who stay safe. They're the ones who diversify away from the consensus. If you want the full math and the implementation checklist, the deep version is in my book Market Cycles Decoded *, link in the description. If this changed your view on defensive concentration, hit subscribe. I'm dropping the sector rotation playbook for fall next Wednesday. Ring the bell so you don't miss it. What's your biggest takeaway? Are you holding more defensive?